Coming up on Market to Market. As a deadline approaches with China, the U.S. signals a deal without details. USMCA clears another hurdle with a finish likely in 2020. The administration vows to keep a promise made on renewable fuels. And commodity market analysis with John Roach next.
Is really.
Pioneer Hybrid International is a proud sponsor of Market to Market.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, December 13 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. The announcement of a trade deal with China had been bouncing around back channel and President Trump's Twitter account for several days. At the end of the week, a deal was announced, though what's in the fine print remains a mystery. The stock and commodity markets moved higher on the news. Peter Tubbs has more.
Initial reports of the trade deal indicate that tariffs currently placed on Chinese imports will be rolled back, and that additional tariffs scheduled to take effect on Monday, December 15th, would be canceled.
This is a very large deal, the China deal. It covers tremendous manufacturing, farming, a lot of rules, regulations, a lot of things are covered. It's a phase one deal, but a lot of big things are covered. And I say affectionately, the farmers are going to have to go out and buy much larger tractors, because it means a lot of business, a tremendous amount of business.
There may be a snapback provision that would reapply tariffs if China does not complete promised purchases. The anticipated amount is sales of $50 billion in U.S. agricultural goods during 2020, double what was purchased from American farmers in 2017. Analysts estimate that American businesses and consumers have paid over $40 billion in tariffs on Chinese products since January 2018. Harvest delays have encouraged the USDA to push the deadline for applications for the Market Facilitation Program and dairy market coverage. The new deadline is now December 20th. The extension comes as dairy prices have declined 4% in the last 2 weeks, reversing an 11% rise over the last 90 days. Block cheddar prices have lost over 4% in the last 2 weeks after a 13% run-up since September. Grain producers have endured a late and wet harvest, with many still in the fields. Retaliatory tariffs have reduced sales of corn and soybeans to China by over 35%, lowering prices at the elevator below the cost of production for many producers. The value of agricultural exports to China in 2019 are down 11% compared to 2017. A third round of MFP payments for the 2019 MFP cycle may be issued in January 2020. The USDA has paid out $18.5 billion in MFP payments since 2018. For Market to Market, I'm Peter Tubbs.
Action at the World Trade Organization's appellate body has effectively ended due to a lack of judges. The U.S. has blocked new appointees for more than a decade over how the group handles trade complaints. It is unclear when the U.S. will return. More on this story can be found at markettomarket.org. Another trade deal was sealed earlier this week as all parties came together over the USMCA. Paul Yeager has more on the landmark trade pact.
3 signatures from representatives of Mexico, Canada, and the United States led to cheers in Mexico City this week. The USMCA earned its first round of approval in November of 2018.
And the result, I think, is the best trade agreement in history. I think it's going to do the most for manufacturing in this region. It's going to do the most for farmers in this region. Its digital trade and e-commerce provisions are the gold standard. There are none better in the world.
But the exact details and language have proven to be challenging and time-consuming.
A year has passed now, and 4 months of that year, we got to blame President Trump because it didn't move, because he had tariffs on aluminum and steel. So it took us almost 5 months to talk the president out of that, take him off. He took him off.
And eventually, many of the hurdles were cleared by the groups working for passage. The Pact nudges manufacturing back to the United States, requiring 40 to 45% of cars eventually be made in the countries that pay auto workers at least $16 an hour.
We were in range for a while, but until we could cross a certain threshold of enforcement for our workers' rights, for environment, and for the prescription drug issue.
The pressure between parties involved in USMCA negotiations was palpable as they tried to balance what would earn passage in each country that wasn't the deal.
These were intense, argumentative, angry negotiations. I mean, this got really hot on a number of occasions. I think we set a world record for hanging up on each other, myself and the trade rep. But at the same time, we also knew that this was an opportunity that we couldn't let get away from us.
Proponents of the USMCA wanted to have the deal ratified by the end of 2019 and out of the 2020 presidential election year. Supporters will have to wait for their gift to come in the new year.
We will not be doing USMCA in the Senate between now and the end of next week. That'll have to come up, in all likelihood, right after the trial is finished in the Senate.
Senator Grassley praised the support from former Obama Secretary of Agriculture Tom Vilsack in seeking approval for the Pact. The dairy industry may be one of the big winners of the NAFTA replacement. Vilsack is now the CEO of the U.S. Dairy Export Council. Mexico and Canada currently import about $1.5 billion of U.S. milk products, more than 25% of all U.S. dairy exports. The pair made a push for passage back in August during a visit to an Iowa dairy production facility. The U.S. International Trade Commission, or USITC, says USMCA would increase U.S. dairy exports to Canada by $227 million as the Class 7 policy restricting imports is removed. Exports to Mexico could rise by more than $50 million. RCAF, the nation's largest producer-only cattle trade association, says USMCA is a win for agribusiness giants at the expense of cattle farmers and ranchers. Other U.S. commodity groups praise the deal as a chance to export more American-raised goods to their already major trading partners to the north and south.
We're going to see a $34 billion investment in manufacturing in the United States. We're going to see 174,000 jobs created. So I think that besides updating NAFTA, which was absolutely necessary, this is a very, very good piece of legislation.
The USITC says USMCA would add $68 billion in GDP and increase food and agricultural exports by $2.2 billion. The Mexican legislature could sign off soon. The Canadians are likely to take the deal up in late January. For Market to Market, I'm Paul Yeager.
Agriculture Secretary Sonny Perdue traveled to the Midwest this week. He told reporters market forces are indicating another round of MFP payments would be necessary next year. Perdue also spoke with a gathering of producers to emphasize the president's plan for the future of ethanol. John Torpy reports.
While giving opening remarks at the Farmers Business Network conference this week, U.S. Department of Agriculture Secretary Sonny Perdue brought some welcome news about ethanol. A crowd of almost 4,000 farmers and ranchers attending the 5th annual gathering, also dubbed the Farmer to Farmer Conference, learned the future blending limits for ethanol will be set at 15 billion gallons and will not be affected by exemption waivers.
The president has gotten the attention here, and he wants me to assure you that 15 billion gallons going forward is going to be 15 billion gallons. The small refinery waivers will still exist, yeah. The small refinery waivers will still exist, but you need to know that exemption is going to be accounted for on top of the line here for a net of 15 billion gallons.
Blending requirements have been a sticking point for the biofuels industry, who have been at odds with the EPA over the issuance of small refinery exemptions, or SREs. The exemptions allow refiners to forego the federal requirement of blending ethanol into the nation's gasoline supply. Ethanol industry officials have routinely challenged the waivers with the Trump administration, citing they diminish the bottom line for farmers in rural America.
Farming's a business. I mean, we love it as a way of life, but it's got to be a livelihood as well. And we've got to ensure that our farming community across this country, in a sustainable fashion, is sustainably profitable in that way.
Jeff Broin, CEO of Poet, the nation's #1 ethanol producer, welcomed the news with a bit of caution, saying the EPA needs to be held accountable to the agreement.
For a farmer to get to sustainability, and to get to sustainability, he has to be profitable. We're going to have to use biofuels as the bridge.
Broin added, getting back to 15 billion gallons could help reopen shuttered ethanol plants, bringing back jobs and helping rural towns.
Very exciting future, I think, for agriculture. If we can grow biofuels to E15, get the price of commodities up, make farming more sustainable, and drive cleaner fuels and a cleaner environment.
From Market to Market, I'm John Torpy.
Next, the Market to Market report.
The announcement on Friday of a trade deal with China overshadowed the rest of this week's trade news, including a USDA report. For the week, March wheat gained 8 cents, while the nearby corn contract climbed 4 cents. The White House says China committed $50 billion in sales, but China has yet to confirm the number. The January contract skyrocketed 18 cents on the rumors and facts. January meal fell $2.40 per ton. March cotton improved 80 cents per hundredweight. Over in the dairy parlor, January Class 3 milk futures declined 67 cents. The livestock sector finished on a high note. The February cattle contract put on $2.57. January feeders added $4.13, and the February lean hog contract moved $1.95 higher. In the currency markets, the U.S. dollar index shed 51 ticks. January crude oil expanded 87 cents per barrel. COMEX gold bumped up $16.20 per ounce, and the Goldman Sachs Commodity Index gained more than 6 points to finish at 427.20. Joining us now to offer insight on these and other trends is our senior market analyst, John Roach. John, welcome back to the table.
Thank you, Delaney. Nice to be here.
John, obviously the big news this week was what happened with the U.S.-China trade news, and I want to kick things off here by asking which commodity, it could be a grain, it could be a livestock commodity, which commodity was the biggest winner from today's announcement?
That's a real good question. We don't know any of the details, and so knowing who's going to get the best benefit is a little bit difficult. But what we think is that the soybean market, a lot of the business that China has needed, they've come in and covered. And so there's just a small period of time between now and the harvest of the Brazilian crop before they will be back competing with us. And so where you'd think maybe beans would be the biggest benefactor, it may actually turn out to be another commodity. And but until we know details, it's just really hard to know. It was interesting in that the meat markets were much stronger today, along with the grain markets, oilseed markets, and even the energy markets and gold markets. So all these markets were all stronger. And part of what's going on is that the commodity index is moving higher, and as the index moves higher, it drags even the weaker commodities higher.
It seems all ships were rising by the news of the U.S.-China trade deal this week.
I think that's a good expression. Yes, exactly.
John, let's talk about the wheat market, because they have been one that doesn't really seem to be impacted by the U.S.-China trade negotiations, but they still had another strong week this week. Where is your current level of resistance for, let's say, the December contract here?
Well, the market was attempting to, in the Chicago market, attempting to get back up to the highs that we made here back a month or two ago. And with the market closing firm today, we think prices will inch our way on up. There's some issues in Europe with weather conditions, issues in Australia with weather conditions, and some now in Argentina. So the wheat market's getting some positive fundamental news. It was the one market that had the ending stocks pulled down down on the report that came out Monday, and has been actually, from a spec trader standpoint, been one of their more positive positions in the market.
John, since you opened up the door there for the WASDE report, of course we had this week, which was overshadowed and maybe not a big report, but January is expected to be the big one here, especially for corn and soybeans. What do you see it doing in January?
Well, I was in Illinois earlier this week, meeting with farmers in the northern part of the country, or northern part of the state, the kind of central north part of the state, and there were a lot of farmers that didn't come to the meeting because the ground froze and they were able to go combine. We saw beans and corn in the field, more acres of that than what I expected. The estimates that we saw from some of the people coming out after the crop progress report on Monday was that there was still something near a million, near a billion bushels of corn still left in the field. So when we see the report in January, we'll see how the government is adjusting for that. We think the numbers need to come down a little bit, but yields were surprisingly good this year. And so we'll have to see how the government reads that here and counts those numbers in January. But we look for a little smaller.
John, I think I would be remiss if I didn't at least mention the big flash sale we saw this week coming from Mexico, specifically buying U.S. corn. Exports have seemed to be what has kept atop on this corn market. Is this week's USDA export sales an indication that perhaps our corn exports are picking up?
I think that's exactly what's happening. The exports satisfying really world demand have come out of South America rather than North America. We've lost business because of their big crops and their cheap currency discounting their price. But they're out, and some people even think they may have to import a little bit into South America. So they really don't have anything available for sale until harvest. And remember, 70% of the Brazilian corn crop is a second crop. So it gets planted in January, February. There'll be 30% of the crop that'll be harvested, but the majority will still be several months away. So we think the export market for corn will be rather brisk as we move through the first half of 2020.
Well, John, with that being said, then we could see USDA alter their January yield and potentially acreage numbers. We could see a big window here for corn exports. What's your price target? What's the high end of where you think corn could trade the next couple of months?
I never know how high prices can go. I mean, it would be nice if you could put your number out there. We pay attention to the momentum of the market. And when we reach the beginning of a peak, we issue a sell signal. And we never know exactly where that peak's going to be, but when the lines cross, we know that our system is saying this is the beginning of the peak. And so we try to keep a relatively open mind as to price level. But let's be a little more specific, because I know you want me to be. I think prices will be moving up as we move in through the first part of the new year. It might be a little bit sluggish unless something comes out of this China program immediately. We've got people needing to sell at the end of the old year and at the beginning of the new year, and farmers are really needing to get some sales made. So I don't think the market has to go up very far to trigger those farmer sales. We've got to get the farmer a little more comfortable financially so that we then can get them into a holding pattern moving on through the winter into the spring. And so I would look for similar kind of price increases as we saw last year from winter into spring. And we're talking 20 to 30 cents on corn.
John, what are the signals showing you in the bean market?
We're nearly to a sell signal. We're just another day or two away from a sell signal in beans. We have a sell signal today in cotton. We have a sell signal today in Minneapolis wheat. So we have markets that are starting to show the beginning of peaks. We have the index moving higher for commodities. That's the reason we think we can gather some steam here and get some sell signals in the next couple of weeks.
John, since you brought up cotton there, we don't often talk about it on the main program, but you said that there is a sell signal in place now for cotton?
Yes, we triggered that, and cotton is getting the same kind of a response, and the optimism from the settling of the Chinese tariffs and trade dispute.
All right, John. Well, this week's report was definitely overshadowed, but there was one thing in particular that stood out to our listener, Bradley in Upland, Nebraska, and that was the USDA's reduction in feed use and residual numbers, even with the record number we have in cattle, pork, and chicken. He'd like to know, are they just lowering the number because production is lower, or will residual use actually decline enough to offset higher feed use?
Whoa, you're getting down into the weeds here. The residual, when we start talking about those kind of details, that actually is very difficult to explain in a short period of time. What I think the USDA is doing is making some adjustments in its baseline and moving their feed and residual numbers to get lined up. I don't think it's a big deal, personally.
Okay. John, is it a big deal this week, the premium that we showed in the cattle complex? I mean, feeders were up even on Friday. They seemed to rally on the news too when it didn't seem that the U.S.-China trade deal was going to be a big deal for the cattle complex. Did they rally on that news or something else going on?
Well, the cattle market's been a very strong market, and so the futures are strong. They're leading the cash, but that's the direction the market wants to move. And when we start seeing the cattle market move in a direction, it seems to just generate its own power as it goes. We are thinking that this next week will be getting some sell signals in cattle and starting to put some hedges on cattle that people want to get protection. But we don't really want to be bearish on any of these meats. We think that the situation with China continues to be positive for meats really around the world, for all proteins around the world. As they are building up their hog herd, they'll be buying in additional meats as they need in order to hold down the inflation on food in their country.
John, when you look at the February live cattle contract, can they continue to be supported at these prices?
I think we can inch a little higher, but we're going to be willing to sell into them next week.
And John, when you look at the feeder cattle market, they had a very strong week this week. Where do they head from here?
Well, I would be cautious with feeder cattle because you have two things working. You have the fat cattle market, which is maybe getting a little toppy, and a corn market that may be about ready to run up a little bit. And so feeder cattle, we think you have to be cautious here a little bit. We don't expect a big down in the market. We just think it's a expensive proposition putting high break-even cattle into the feedlot.
And John, what would you be recommending to those feedlot producers in the case that corn may have a potential rally in sight? What protection strategies are you recommending right now?
I think if you're in the livestock feeding business, you should own all of your corn or most of it, and you should own all of your protein or most of it. We've gone through the negative part of the market, and we've spent a year or longer than a year battling our biggest customer. We've watched our biggest customer lose half of their hog herd. And so that's the history. We also had monster crops in South America and monster crops in the United States a year ago. We didn't this year. So our surpluses are coming down. The opportunity, really risk opportunity, there's more risk to the upside than there is the downside, in our opinion, for the livestock feeder as far as feed's concerned.
And John, let's round out the conversation with the lean hog market. I wanted to ask in particular, the December contract finished down on today, even with the U.S.-China trade news, while the deferred contracts had a large premium being built in. Why did the December not react to today's news?
We have too many hogs right now, and our numbers have been big. In fact, as we've had a problem kind of a market for the past couple of weeks, the market's really been pressured. We were ready for the Chinese business, and the Chinese business hasn't really materialized to the size we thought it would. And so now the market's encouraging more pork production out into the future, and that's what's giving the prices moving higher to do that.
And John, how much of a cap do you think we're going to continue to see as we increase pork production, but hopefully China buys here in the short term? How much of a cap, I guess, will we put on that if we continue to see large increases in production?
Well, again, it's a question of size. It's a question of how big the Chinese market is for pork for right now and how quickly they buy. And they can literally come in and clean up all surplus, or they can continue to go slow and allow us to kind of wallow around in that surplus a little bit. That's what we've been doing. And the good news is that there's a change here. And I think we have to, for a moment, stop and say, let me just give this a minute. Let me give it a minute here. Let me watch and I know you feel a little bit like Charlie Brown and having the football pulled out by Lucy, but this time it looks like the football's going to stay there, and so give it a few more days before you do anything very rash. This could be a real big surge of demand in 2020.
And John, let's say we do see that surge in demand. How much more could we see the lean hog market rally?
we could go back to the contract highs if we have the right kind of business come at us.
All right. John Roach, thank you so much. Always a pleasure.
Thank you very much, Delaney. Nice to be here. Merry Christmas.
Merry Christmas to you too, John. That wraps up the broadcast portion of Market to Market, but we will keep this conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at markettomarket.org. Facebook allows you to keep track of your favorite interests, including those in rural America. You can find our links and photos at IPTV Market. Join us again next week when we'll explore how a group of farmers are growing their operations by sharing their talents. So until then, thanks for watching and have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.